So imagine you're looking at your phone this morning. You open up your banking app, maybe just to check on a payment or something, and you glance over at the exchange rate, and you see a number that just feels like a glitch. The Israeli Shekel, trading against the U.S. dollar at 3.10.
Which is a number that sends a very specific shiver down the spine of anyone who's been tracking this economy for the last, 20 years?
Yeah, that's historic territory.
Absolutely.
It's just so jarring because, we've all been on this absolute roller coaster for the last year. We saw the rate sitting around, 3.68.
Get comfortable.
And the war breaks out and it spikes past 4.0. And there was this collective panic that the whole thing was going to free fall. But now we've swung all the way back to the other extreme.
That kind of volatility, swinging from panic selling to historic strength in such a short period of time, that's rare. It tells you something deeper is going on.
Right.
It's not just about the news cycle. There are these tectonic plates moving underneath the Israeli economy that are much stronger than the daily headlines.
And that's exactly what we're unpacking today.
Yeah.
We've got a whole stack of reports and analysis here that suggest the Israeli economy has, it's fundamentally mutated. And because it's changed, the old playbook, specifically the Bank of Israel's free floating policy, might be dangerously obsolete.
It's a classic case of using a map for a city that's been completely rebuilt. The streets are just different now.
But hold on, before we jump into the solution, and we do have a very specific, maybe a big controversial proposal to talk about called the exchange rate band, I kind of want to push back on the premise.
Okay.
Because for a lot of people listening, a rate of 3.90, that sounds like a victory.
Yeah.
Right? If I'm buying a new laptop from the U.S. or booking a vacation, my shekels are superpowered. Why should I care if the dollar is cheap?
And that's the consumer perspective, and you're absolutely right. For importing goods, it's a party.
Yeah.
But you have to switch hats. You have to think like the producer. Think about, a factory owner in the north of Israel who makes irrigation pipes or plastics. They pay their workers in shekels. They pay their rent in shekels. But they sell their product to Europe or America in dollars or euros.
So when the shekel gets stronger, their costs stay the same, but their revenue effectively just shrinks.
It evaporates, and it happens fast. If the dollar drops from 3.80 down to 3.90, that factory just lost nearly 20% of its revenue overnight.
Wow.
And they didn't do anything wrong. Their product isn't worse. Their marketing isn't worse. The currency just priced them out of the global market.
It sounds a lot like Dutch disease. I know we try to avoid the textbook jargon, but that's the term, right?
It is.
We're a booming resource sector, in Israel's case, high tech, sucks so much capital into the country that it just kills off the traditional industries.
That is precisely the mechanism.
Yeah.
The success of the startup nation is inadvertently strangling the industrial nation. And the data we have here, it shows this isn't a temporary phase.
It's something else.
The sources call it structural appreciation.
Okay, let's dig into that term, structural appreciation. Because usually, currencies bounce around based on sentiment. Traders get nervous, they sell, they get happy, they buy. But this analysis is suggesting this is stickier than just a mood.
It's much stickier. If you look at the basic balance of payments, which is basically the sum of the current account, so trade in goods and services, plus direct foreign investment.
Right.
In Israel, that number is persistently massively positive.
Meaning more money is flowing in than is flowing out. Consistently.
Billions more. And it's coming from two distinct fire hoses. One is that current account surplus Israel simply exports more services than it imports. But the second fire hose is the one that's really changed the game, foreign direct investment, specifically into tech.
And this is different from hot money, isn't it? This isn't just someone buying a stock on Monday and then selling it on Tuesday.
That's a crucial distinction.
Yeah.
Yeah. When a global giant buys an Israeli software company or builds an R&D center in Tel Aviv, that capital is committed. It's long-term.
It's not going anywhere.
Exactly. They're converting huge amounts of dollars into shekels to pay salaries, rent offices, build infrastructure. They're not going to pull that money out just because of a bad news cycle.
So you have this constant, relentless demand for shekels coming from the tech sector. That's like a vacuum cleaner, just sucking up all the available shekels and dumping dollars into the market.
Which naturally drives the price of the shekel up and the dollar down. And the source material points out a really interesting correlation here with the NASDAQ.
Oh, I saw that chart. It's almost a one-to-one movement. When the U.S. tech sector booms, the shekel gets stronger.
Because Israeli tech is essentially an extension of Silicon Valley. When the NASDAQ rises, capital flows to Israeli tech companies, and the shekel strengthens. But here's the problem.
Go on.
The factory making plastic cups down in the Negev doesn't benefit from the NASDAQ booming, but they are punished by the currency appreciation that comes with it.
So the invisible hand of the market is basically giving a high five to the software engineer in Tel Aviv and a slap in the face to the factory worker in the periphery.
And that creates this really dangerous duality in the economy. You end up with a wealthy, insulated tech sector and a hollowed-out industrial base.
Which brings us to the referee in all this, the Bank of Israel. Right now, their official policy is a floating exchange rate.
The market decides.
Right, the market decides the price, but we know that's not strictly true. I mean, they have something like $200 billion in reserves. They definitely get involved.
They do, but the current strategy is, let's call it constructive ambiguity. They let the market float, but if things get too volatile or the rate drops too fast, they jump in and buy dollars to soften the blow.
But the critique in our source material here is that this ambiguity is actually backfiring.
It is. It's failing on two fronts. First, because there are no clear rules, the market is constantly testing the bank. Traders push the rate down just to see if the bank will blink.
Like a kid testing their parents' patience. Can I stay up till 10? How about 10.15?
Exactly. And if the parent only sometimes says no, the kid just keeps pushing. And the second failure is perception. When the bank intervenes sporadically, it looks like panic.
But worse.
Or worse, it looks like manipulation. If you buy a bunch of dollars on a Tuesday with no explanation, the U.S. Treasury might look at that and say, hey, are you artificially suppressing your currency to help your exporters? That's not allowed.
Nobody wants to be labeled a currency manipulator. That invites sanctions and trade disputes.
So we're stuck. We have this floating system that doesn't really float because the bank keeps interfering, but the interference is random enough that it provides zero real stability for businesses.
The worst of both worlds.
It really is.
So enter the proposal. The research paper we're looking at argues it's time to stop pretending. They're proposing a formal exchange rate band. And they aren't vague about it. They put specific numbers on the table. A floor of 3.05 ILS and a ceiling of 3.90 ILS.
3.05 to 3.90. It's a wide band. It's a wide band.
It's a very wide band. Now, I want to get the mechanics right because my first thought was bowling bumpers. But reading through this, it seems more sophisticated than that. It's more like an options contract, isn't it?
That is a much better way to think about it. Yeah. Imagine the central bank is effectively writing a put option for the entire market at 3.05.
Okay.
They're saying to the market, we guarantee that if you want to sell dollars, the price will never, ever be lower than 3.05.
And on the other side, they're writing a call option at 3.98. The price will never be higher than this.
Precisely. And within that range, between 3.05 and 3.90, the market is completely free. The Bank of Israel does nothing. They sit on their hands. Supply and demand rule the day.
But the second the price hits 3.05,
the bank enters the market with unlimited firepower. And this is the important part. A central bank cannot run out of its own currency. They can print as many shekels as they need to buy up all the excess dollars and defend that floor.
Okay, hold on. I have to play the skeptic for a second here. We've seen central banks try to fight the market before and lose. Spectacularly. I'm thinking of George Soros breaking the Bank of England in '92.
Of course.
The UK tried to defend a currency peg. The market smelled blood in the water, and they crushed the bank. Why is this different?
That is the nightmare scenario every central banker wakes up sweating about. But the dynamics here are fundamentally different. In the Soros case, the Bank of England was trying to prop up a weak currency.
Wow.
They had to use their limited reserves of foreign cash to buy their own dying currency, and eventually they just ran out.
They ran out of ammo.
Right. But in Israel's case, we're dealing with a strong currency. The pressure is for the shekel to appreciate, to get stronger. To stop that, the bank needs to sell shekels and buy dollars.
And since they can create shekels,
they theoretically have infinite ammo. They can't run out of shekels. Now, there are consequences, of course. If you print too much, you risk inflation. That's the real risk. But in terms of pure market mechanics, a central bank fighting appreciation is infinitely stronger than one fighting depreciation.
That makes a lot of sense. So the risk isn't going broke. It's potentially inflating the economy. But let's assume they can manage the inflation side. What are the actual benefits of locking ourselves into this 3.05 to 3.90 cage?
The authors argue there are three massive wins. The first one helps solve that whole currency manipulator problem we were just talking about. International legitimacy.
Because you're just declaring the rules up front. Here's what we're doing.
Yes. Transparency is the currency of diplomacy. If you announce, here's our policy, here is our ban, we only intervene at the edges, then the IMF, the U.S. Treasury, they understand that. It's a recognized monetary framework.
It's not sneaky anymore.
It stops being sneaky intervention and it becomes monetary policy.
It's like the difference between a referee just making up calls as they go and a referee who's following a clear rule book. Everyone might hate the rule, but at least they know what it is.
And that leads directly to the second benefit, which is, the holy grail for any business.
Certainty.
Yeah.
I can only imagine if I'm the CFO of a manufacturing company and I'm trying to sign a 3-year contract to sell parts to Mercedes or Boeing, I'm terrified of the exchange rate.
You're paralyzed. Your business is paralyzed. You can't hire, you can't invest in new machinery because you have no idea if the shekel will be 3.0 or 3.60 next year. That 15% swing is your entire profit margin.
So the ban doesn't give you a fixed price, but it does remove the catastrophe, the tail risk.
Exactly. The worst case scenario is 3.05. You can plan for that. You can hedge for that. It turns an existential threat into just a manageable line item on a spreadsheet.
Now, the third benefit is the one that I found most intellectually fascinating. It's about market psychology. The report calls it expectation management.
Yes. Paul Krugman wrote about this years ago, the target zone theory. It's the idea that if the band is credible, the market will actually do the bank's work for it.
How does that even work? Why would greedy traders ever help the central bank?
It's pure self-interest. Let's say the shekel strengthens and hits, say, 3.0, so it's getting close to that 3.05 floor.
Okay.
Traders know the bank is committed to defending 3.05. They know the bank has infinite shekels to do it. So are you really going to bet on the rate going to 3.00?
No, that's a guaranteed loss.
So instead, you start betting the other way. You assume it will bounce. You start buying dollars before it even hits the floor.
So the speculators actually prevent the rate from hitting the limit because they're front-running the central bank's intervention.
Precisely. The expectations themselves act as a shock absorber. The rate tends to hover in the middle of the band, away from the edges, simply because the edges are credible electric fences. They call this the honeymoon effect.
So you get stability without the bank actually having to spend billions every day.
That's the theory.
That sounds almost too good to be true.
Right.
I mean, it's this logical, it gives legitimacy, it saves exporters, it stabilizes the market. Why hasn't the Bank of Israel done it already? What's holding them back?
Fear of the past, mostly. And a bit of economic dogma. There's a very strong school of thought that says a pure float is the only sophisticated way to run a modern economy.
Right.
Any form of intervention is seen as a regression to the 1980s or 90s, back when Israel had hyperinflation and the government tried to control everything.
So moving to a band, it feels like admitting defeat, like we aren't a grown-up economy anymore.
To some economists, yes. They argue that the market knows best. If the shekel is 3.10, it should be 3.10. And if that kills the industrial sector, well, that's just efficient capital allocation.
That sounds incredibly cold. Efficient, but brutal.
That's the friction. The Bank of Israel has a dual mandate. Price stability, so fighting inflation and supporting growth. For the last decade, they've been obsessed with inflation targeting. They worry that if they commit to a band, they lose the ability to fight inflation effectively.
How so?
Well, imagine inflation spikes up. To fight it, you usually raise interest rates, which makes your currency stronger.
Right.
But if you've promised to keep the currency weak or so above 3.05, you might be trapped. You might have to choose between your inflation target and your exchange rate target.
That's a real dilemma.
Yeah.
So it's not just stubbornness.
No, it's a genuine policy trade-off.
Yeah.
But the counter-argument, and the one our source is making, is that this structural appreciation is so extreme and the damage to the real economy is so severe that sticking to inflation targeting alone is like steering a ship by looking only at the speedometer and ignoring the iceberg dead ahead.
The iceberg being the complete collapse of the manufacturing sector.
Right. You might have low inflation, but you also have 15% unemployment in the periphery because all the factories closed. Is that really a victory?
So the proposal is really just saying, look, the economy has matured. We have these massive inflows. We need to adapt the rules to fit this new reality rather than clinging to a pure float theory that doesn't account for the unique distortions of the Israeli tech boom.
It's an operational shift. It's saying we are strong enough to set boundaries. The band of 3.05 to 3.90 is wide enough to allow for market movement. It's not a rigid peg, but it signals that we care about the survival of our tradable sector.
It's basically giving the startup nation a way to coexist with the rest of the nation.
That's the goal, diversification. Because if tech crashes, and tech does crash, we've seen it happen before, you need those other industries to still be there. You can't let them rust away just because the shekel was too strong for 5 years.
I want to leave our listeners with a thought that really struck me while I was reading the very end of this report. It's a bit of a provocative question.
Go for it.
We're talking about setting a floor at 3.05 to save the exporters. But if the pressure from tech is as strong and as structural as we say it is, isn't it possible that the real natural price of the shekel is something like 2.55 or even 2.0?
That is the elephant in the room?
If that's true, then by setting a band, aren't we essentially enforcing a massive permanent subsidy? We're taking wealth from the tech sector and from consumers who would benefit from super cheap imports, and we're artificially transferring it to factory owners.
You are absolutely right. That is the wealth transfer. You are making imports more expensive for every single Israeli citizen in order to keep those factories alive.
So the question isn't just, will this work? The real question is it fair?
And that is a question of values, not just economics. Do we value a diverse economy with blue-collar jobs enough to pay a premium for it? Or do we just let the market rip, enjoy our cheap Amazon packages, and accept that traditional industry might just vanish from Israel?
It seems like finance always circles back to philosophy in the end. It's just a set of rules we choose to live by.
And right now, the rules might need a serious rewrite.
Fascinating stuff. We'll definitely be watching to see if the Bank of Israel takes any of this advice. Thanks for diving deep with us.
Always a pleasure.